Today, we're going to break down how smart investors handle wild market swings. We're using real data and proven strategies. No hype, no fluff, just the hard numbers you need to know.
So, here's the big question, right? The market takes a nosedive, your stomach's in a knot, and every single instinct in your body is screaming, sell, get out now. But is that actually the right move?
Well, before we can answer that, we have to understand what's going on in our own heads. This first part is all about the psychological trap that volatility sets for us. So, what even is market volatility? It's just a fancy term for when prices swing like crazy. It's like a roller coaster. Huge highs and terrifying drops all in a short amount of time. It's designed to feel unsettling, to really test your nerve. And that feeling you get, that gut punch urge to just do something, that's totally natural. It's human. But the hard truth, the one that's backed by decades of data, is that reacting is almost always the single most expensive mistake you can make. All right, so let's move away from feelings and get straight to the facts. This is where we look at the cold, hard numbers and see what hitting the panic button actually costs you. Take a look at this number. Data from Lord Abbott shows that, on average, the stock market has a drop of nearly 14% at some point within any given year. That feels awful, right? It's a big dip, and it happens way more often than you'd think. But here's the other side of that story. In most of those exact same years, the ones with that scary 14% drop, the S&P 500 still ended up with a positive average return of over 13%. The lesson here is huge. Those scary drops are usually just noise in a much longer upward journey. And this table just perfectly illustrates the price of panic. Look at this. If you put 10 grand in the market and just left it alone for the past couple of decades, it would have grown to over $74,000. But if you got scared, pulled your money out, and missed just the 10 best days, your return gets sliced in half. Miss the 30 best days? You've barely made a dime. It's proof that trying to time the market is a fool's errand. Okay, so if we know panic selling is the wrong move, what is the right one? Let's get into the actual playbook. 4 simple, disciplined rules to see you through any market. Rule number 1 is the foundation of everything. You cannot put all of your eggs in one basket. Diversification is your first line of defense. It's all about spreading your money around so that one bad bet doesn't completely sink your ship. Here's a really simple example based on models from Fidelity. You've got a mix of US stocks, some foreign stocks, and a good chunk in bonds. See, when stocks are going wild, bonds can often act as a stabilizer. The goal isn't to never lose money, it's to smooth out the ride so you don't get thrown off. Now, rule number 2, and honestly, this might be the most important one of all. You have to zoom out. You've got to stop staring at the daily price swings and start thinking in years, or even better, decades. This quote really says it all. You've heard it before, I'm sure. It's not about being a genius who can predict the future. It's about having the patience and the discipline to just stay in the game. Real wealth is built by being there for the good days, which almost always follow the bad days. So, how do you actually do that? How do you stay in the market? Simple. You build a system. You take the emotion and all the guesswork completely out of the process by investing on a fixed schedule no matter what the news is yelling about. This is called dollar cost averaging, and it's brilliant. You just invest the same amount of money on the same day every month. When the market is down, your money automatically buys more shares. When the market is up, it buys fewer. Over time, this actually lowers your average cost and turns scary market dips into fantastic buying opportunities. And our final rule is what holds all the others together. You can have the most perfect plan in the world, but it's totally useless if you don't have the discipline to stick with it. This is all about trusting the strategy you've built and refusing to let fear or greed make your decisions for you. Okay, let's wrap this up by putting it all into a really powerful perspective. Let's zoom all the way out and look at the single biggest weapon you have in your arsenal as an investor. Just look at this chart. Seriously, let this sink in. Since 1980, we've had brutal market crashes, recessions, wars, a global pandemic, you name it. And every single one of those events felt like the end of the world at the time. And yet, through all of that noise, all that chaos, a simple $10,000 investment grew to almost $1.5 million. Time is the most powerful force in investing, period. So here's the big takeaway. It's time to change your mindset. A market downturn isn't just a risk to be afraid of. For the investor who has a plan and stays disciplined, it's actually an incredible opportunity. It's a fire sale, a chance to buy into great companies at a discount.
And that leaves us with one final question for you to think about. When you look at your own investments, your own strategy, ask yourself, is it built to make me react to the next headline? Or is it built to last for the long haul?